So that, I think, is actually one of the very important things that's come out of how we work together. So what that means in terms of syndication is that really syndication, and almost everything that Common Angels does is syndicated. We typically do a $2 million Series A right around go-to-market where we're a third to half the capital and the lead. And so we syndicate with individuals, other angel groups, venture firms, corporate, the whole 9 yards. And quantitatively, just to give you a ballpark of it, we've put in about $45 million of our money, and I have worked with companies to raise over $250 million of co-investment. So it gives you a sense of the ratio. That alignment of strategy is really fundamental. And within the New England Angel Capital Association, obviously a lot of the groups have their strategies aligned because they have stated strategies, they're ACA members, but some don't. And I think getting that on the table is really the first and foremost thing. And then I think next term I'll talk about the role of the lead investor, which is another critical lesson learned.
Yeah, and what James said, I think the biggest thing that I've seen is entrepreneurs not having a really strong capital strategy where they, as James mentioned, take investment from the wrong type of investors that doesn't really have a high probability of success. Entrepreneurs get excited the fact that they have somebody that's willing to extend them a term sheet and don't do enough due diligence. And I think it's the #1 killer of a startup is running out of money. And it's really that capital strategy that will dictate if you were set up initially to be able to have the longevity that you're going to need to figure out product market fit and get some traction. What's interesting when I first moved to Silicon Valley was that a lot of the well-known angels would meet with entrepreneurs, and their message was, make sure you raise enough money, because as an entrepreneur, they would come in and they would say, we only need $100,000 and we're going to build this product and we're going to get traction and we're going to monetize this way. And this was September, so it's kind of funny because I've seen this month of kind of like everybody's drinking the Kool-Aid and then the after effect. And so during the Kool-Aid month, people were raising capital, saying we don't need a lot and we're going to get traction, et cetera, et cetera. And investors weren't doing deals because the entrepreneurs weren't raising enough. And I thought that was interesting as kind of the thought pattern behind what they were trying to do with their company. Because they knew that they need to raise enough capital to give them a runway where they could build meaningful adoption so that they were attractive to either a Series A or a VC type investment. After September, what I've noticed, and Dave will talk about this, I know the consumer internet space. That's kind of, I invest predominantly in there, but I also do other things. And now, as an early seed investor, it's actually kind of interesting to see a company get to profitability or break even. So whereas in the past it might have been enough funding to get to the Series A, some companies on $300,000 or $400,000 can get to a point, as Dave mentioned last night in his keynote. FB Fund, he had 5 companies out of 27 that got to revenue generation, and some of them actually break even, which is pretty amazing in a 3-month period. So that's kind of
non-Silicon Valley.
Yeah, yeah. To see them wear T-shirts saying, yeah, revenue is sexy, where it's usually about like this huge valuation and trying to kind of amp up that story. It was really interesting, and that's a trend. So
Dan, have you syndicated early in your deals that you've done recently?
Yeah. So it's again, I don't have like formal syndicates. I usually get involved. I'm leading my first round now out of the 7 I've done, and the other ones, moving to San Francisco, I was a nobody, and down there you have to add value as an investor. You can't just be capital, because they want, it's either prestige or some kind of stature, and so I definitely had to fight my way into the couple deals I've done. And yeah, so always syndicated through angels, but not through an angel group per se, just as other individuals. Most of the people, it's always been their money as well as my own. So that's kind of.
And on, I guess for both of you, sort of trying to determine, do you actively look at sort of the lifetime capital required, not just by the whole deal, but yourself to be able to participate in those next rounds of financing?
Oh, absolutely. So there's a reason why Common Angels is migrated from 5 years ago. We would do a $500,000 investment, and today it's pretty much our standard deal is $2 million, and it's the same thing that Dan was just mentioning, and it's also what's come up earlier is, you need to have enough runway to not only hit the proof points to really see if you have a business, but also the capacity around the syndicate to walk away from the table. I've heard several comments today about, how do we deal with VCs, as if that's a
Bad thing.
bad thing, yes. I was trying to find another way to say that, but it's, I think that is the perception. And again, I think talking through strategy heavily within the Northeast, we've really come to this issue of the overall financial strategy of the company, the capacity of investors, but also a lot of clarity around that there are really two fundamental reasons for a failed investment. And one is acceptable and one isn't. And it's really the second that I think most people are complaining about. The one that's acceptable is operational failure. It's disappointing. It's particularly disappointing, as we heard earlier, if someone like sucks money out of the company for personal purposes, that may border on legal issues. But we know that 8 or 9 out of 10 of these things are going to go south. That's just the nature of this business. That ought to be okay as long as it's done with good effort, nobly, honestly, best effort, so on. What's unacceptable is financial failure. And what I mean by that is you have an operational success, but you get creamed as an early investor. And the number one way you get creamed is, of course, the bad version of the golden rule. He who has the gold rules. And that happens when you don't have enough capacity or the company's underfunded from the get-go, and when they start hitting their numbers but still need cash, the next guy takes advantage of you. We as angel investors have a very fundamental and important moment of decision to make when we do that initial round or the one immediately after, and that's who our partners are. After that, we live with the consequences for the life of the company, and that's what I'd like to, when we come to good and bad lessons, really focus on. We have the ability to influence it. We are not passive actors that are at the mercy of the company or the other investors. And if we get creamed, we ought to look in the mirror about why that happened.